The next financial statement we're going to talk about is the income statement. The income statement tells us if the company is profitable or not. The income statement is simply revenues minus expenses equals net income. Net income is a synonym for profits. Revenues are cash and promises received from the delivery of goods and services. So it doesn't necessarily equal cash, because we can generate a revenue by providing goods or services and only get a receivable from doing that, meaning that the customer promises to pay us in the future. As long as we've done our work by providing the good or service, we've earned the revenue. Students struggle in this class because they always focus on money. Oh, we didn't get the money, so it doesn't count. That doesn't matter. Did you provide the good or service? Yeah. Is somebody going to be pissed off if you don't pay them? Yeah. So revenue is generated. So if I provide a good or service to you, even if you haven't paid me, I've earned it. And if you don't pay me, I'm going to go after you. I want my money. So revenue is recorded when earned. That's the key word for revenue. We record it when we earn it. How do we earn it? By providing the good or service. There's all sorts of different types of revenue. Sales revenue is the generic term for the sale of our goods or services. We could have fees revenue, like Netflix has fees revenue for their program, the subscription fees that they're charging. Interest revenue is revenue that we earn by investing money. Rent revenue, obviously, could be revenue generated from renting property, and basically you can make anything into a revenue by adding the word revenue to it. However, one caution is that word unearned revenue we learned when we talked about the balance sheet. That's a liability because we haven't earned it yet. Revenues are only things that we've earned by providing the good or service. Expenses are the resources we use to earn those revenues. So they're the various costs associated with earning the revenues. Like when Walmart sells us items, the cost of those items are referred to as cost of goods sold. That's an expense. It's a cost of selling the items. In addition, Walmart has to pay their employees, so they have wage expense. They might have to rent the store itself, the property, so they have rent expense. Depreciation expense we'll learn about later on basically is the allocation of the cost of a long-term asset. So you have a building. The building is going to last more than 1 year, so we don't expense the cost all in the year of purchase. We allocate it over the life of the building or equipment. And then you can have anything else that's an expense. Insurance expense, repair expense, income tax expense. Anything and everything could be considered an expense if it's part of the cost of doing business. So you don't need to memorize all of these different terms. You just need to recognize what an expense is. And if it's an expense related to providing coffee, it could be called coffee expense. The name isn't that important. Cost of goods sold is one you might want to pay a little more attention to than the others because it doesn't have the word expense in it to clue you off that it's an expense, but cost is really a synonym for expense. And cost of goods sold, the beauty of the name is it tells you exactly what it is. It's the cost of the goods that we sell to our customers. So don't overthink this stuff. It's really not as hard as it seems. The difference between those revenues and expenses are going to be our profits or net income. And we always want our revenues to be more than expenses, but sometimes that won't always be the case, especially when a company first starts out in business. When they first start out, a lot of times they operate at a loss initially as they try to market their product and generate brand recognition. That doesn't mean the company is a bad company. Usually companies do struggle through that growth phase. And eventually, though, they need to get over it, over the hurdle, and generate profit. Otherwise, they won't be sustainable in the long term. So here again is the income statement equation. Revenues minus expenses equals net income. Another fundamental equation that we're going to use throughout the semester. What you'll learn in this class, and it's going to be frustrating, is there are various synonyms for different words. And you might ask yourself, why can't the book or Berube be consistent in his use of the terminology? And the reason is because I'm not preparing you just for an exam. I'm preparing you for the real world. And if I call it net income, but your boss calls it profit or earnings, and you have no clue that they're the exact same thing, then I'm not doing my job in preparing you for your future. So get used to the different synonyms. You'll struggle at times. You can always look it up, look in your notes. But another synonym for net income would be profit or net earnings, or the bottom line is also a term used to refer to that net income of a business. Here's an example of the Nature's income statement. You can see it's simply revenues minus expenses equals net income. And they got a positive number for net income, which means that their inflows are greater than their outflows. And again, you can look through the explanation to get a better understanding of what each of these terms represent. Going to move on to the statement of stockholders' equity. It's tied in with the income statement because net income is going to be part of it. The statement of stockholders' equity, remember that's our E in our fundamental equation A equals L plus E, basically tells us how E, or equity, changes. Equity, remember, is made up of common stock and retained earnings. So the statement of stockholders' equity is going to tell us how those two items change. Common stock's quite simple. It changes when you sell stock. So it's the beginning common stock plus any new stock sold equals ending common stock. That's it. The only way common stock is going to change is if you sell more of it. So you go onto Shark Tank, you sell them more stock, your common stock is going to go up. Retained earnings, because of the term itself, you should understand that that's the earnings the business keeps. Well, the only other option aside from keeping it is giving it away in the form of dividends, which is why the formula beginning retained earnings plus the new earnings, net income, minus the dividends, is how you get ending retained earnings. So that's another fundamental formula that we're going to use throughout the semester. It should be logical. It's not just me telling you like pi r squared or something like that we learned in the past and maybe don't remember what it's for. I think that's the area of a circle. It's a fundamental formula that actually makes sense. Beginning retained earnings, what I had at the beginning of the period, plus new earnings, minus what I give away in the form of dividends is what I have left at the end. It should make some sense. Here's an example of a statement of stockholders' equity. You could see that common stock for La Nature stayed at 55.7, and that's because there were no new shares sold during the period. And then retained earnings is the beginning plus the net income minus the dividends.